As we put out last week, our Canadian permanent portfolio is now up 7.7% year to date. In fact, it's up almost 6% just in the last 2 months alone. And this is a stark change from what we've been seeing through most of this year. In fact, going into September was a very bad month as the Fed funds rate got to 5.5%, and the market's belief was that the Fed was going to continue to raise rates. So markets were in a very tight and scared position. Subsequently, we've seen some weaker economic data globally, and we've seen inflation numbers starting to come down, so that now the market has done almost a complete 180 where it's believing that not only is the Fed done tightening, but it's actually going to start cutting interest rates because of the weak economy and the relief on the interest rate front. Now, just to remind viewers, over the course of the past year, the Fed has been tightening, mainly raising interest rates, but also reducing the size of their balance sheet. Following the COVID crisis, the Fed's balance sheet was over $9 trillion. And this was from the money that was printed to help the economy through the lockdowns that we experienced. So the banking system absorbed a huge trillions and trillions of excess deposits that they didn't need or want to lend into the market. So what the banks did is they posted this money in the form of reverse repos at the Federal Reserve, where instead of lending this money, they would earn an interest rate on that money held at the Federal Reserve. Well, now we're starting to see in the last couple of weeks that money is coming back into the system now, so that the money supply numbers that have been going straight down for the past year, and in fact, we've never seen anything like it, where M2 has been declining for such a long time, has been so negative, but now it's starting to turn and we're heading up because that excess money is coming back into the system, which is helping, I think, asset prices turn the corner here where stocks, bonds, and risk assets are now starting to rise. The question is, how long can this last? Because the reverse repo, which started at 2.3 trillion, is now below a trillion. And when that money runs out, the markets are basically saying the Fed's going to potentially have to really loosen as a form of funding the government $2 trillion deficit, but also the economy in general. So while it's nice that markets are rallying here, it's quite possible that this Fed tightening is going to cause a recession in 2024, simply because borrowing costs have gone up so much, and with so many loans coming due over the next year or two, this could act as a real anchor on economic growth. So it's a nice little respite here, but I'm not sure that we're out of the woods economically heading into 2024. The price of gold has been rallying quite strongly lately. In fact, it hit an all-time high on the first day of December last Friday, which is a very, very bullish price action. Historically, when commodities trade at new highs, the commodity often goes a lot higher because it's a major breakout, and that's how commodities tend to trade. Now, the gold price has pulled back a little bit, but it's very exciting. In our Canadian permanent portfolio and U.S. permanent portfolio, we have a 20% gold weighting and a 5% silver weighting. So if gold is about to break out here, this could be very good for our performance heading forward. Now, what's interesting about gold, it's kind of an asset that hasn't been appreciated for years because, with modern portfolio theory being created in the 1950s, the establishment has kind of pushed gold to the sidelines, saying you don't need it. A portfolio of 60% bonds, 40% bonds, 60% stocks with a rebalancing would be enough. However, I've never been a big believer in that. And I do think that with what we're seeing in the paper market, specifically Western governments running huge deficits, coupled with two ongoing wars, coupled with the higher borrowing costs because of the Fed's recent interest rate increases, paper is going to be devalued considerably going forward. And I think that's really what the gold price is reflecting right now. Interestingly enough, gold and silver have a relationship throughout history. In the past, gold and silver were usually in a 10 to 15 times relationship, meaning silver was worth 1/10 or 1/15 the price of gold. And throughout history, it could be pegged at that or it would trade roughly in that range. However, now silver is 1/83rd an ounce of gold. So we're so out of sync historically. Some of the reasons are that silver is no longer part of the monetary system. Gold is, and silver hasn't really been used as a monetary asset, although it's used industrially. So We have a 5% weighting in silver in the permanent portfolio, and I'm hoping that with gold being in a new bull market, that silver will come along. Interesting, with gold hitting an all-time high, silver's right now around $25, $26, which is half of its all-time high that was hit in 1980. So silver is really, really cheap here, and I'm hoping that we can get some big movements out of the silver price over the next couple of years. I do believe we're heading into a commodity bull market with wars going on and fiscal problems. I think commodities are going to be a desired asset, are going to go up in price, and that through our exposure to gold and silver, we have a nice exposure to that asset class. It should do us very well over the next couple of years with the permanent portfolios.